Welcome everyone. We've done this small video to explain a few bits and pieces regarding the pensions in our current dispute on London Underground. Very happy to have Martin Sherry next to me, the Tier 2 rep for trains, and our special guest is Steve Hedley, the Senior Assistant General Secretary of our union, and also the Pensions Trustee on London Underground. So Steve, welcome. Thank you for coming down and speaking to us. Could you just, right at the beginning, explain to us what a trustee is and what they do?
Well, a trustee is responsible for the running of the TfL pension scheme, for taking decisions. If the scheme, for example, was in trouble, then we would have to take measures to make that scheme viable again. I think I've explained before, Carlos, that the scheme isn't in trouble. I sit on a board that's made up of half trade union members and half management members and an independent chair. And every person on that board has said that not only is there no problem with the scheme, we're actually doing very, very well. We've got a surplus at the minute, a surplus of £180 million.
Thanks, Steve, because that's quite an important point. Like, I mean, you say the scheme is working well. So why do London Underground want to change that scheme?
Well, to be quite honest, I don't think London Underground do want to change the scheme. I think the pressure to change the scheme is coming from national government. And I think it's an opportunistic use of the COVID crisis by national government to attack one of the best schemes in the country, one of the best final salary schemes. And I just think that they don't like the fact that working class people who work on the underground can live an old age in their pension without having to run the food banks. I think it actually absolutely infuriates them. And it's by no means a gold-plated pension. The average pension people take is £10,000 a year. But I think they're absolutely infuriated by the fact that people are getting a decent pension from London Underground, a TfL, and they want to smash it up.
Thanks, Steve.
Okay, Steve, if the scheme was closed to new members, how long would it take before it closed completely?
Well, that's a difficult question to work out. There have been, in the past, several examples of schemes that have been closed to new members. And if you think that if there's no new money coming into the scheme, and there's money going out paying pensioners and future pensioners, then the scheme itself will run down, the assets in the scheme will run down. Now, that's not to say it will close. There are other options. There will be options like paying more from the people who are already paying into the scheme. But we have seen places where, when it's been closed to new entrants, the scheme has eventually been closed entirely. Or we've got situations like we've had on Greater Anglia, where the amount of contributions asked for existing members got so high that people just said, we can't afford that. They were looking up to over a third of their gross salary. So we have a situation where if new money is stopped coming in, if new entrants are stopped coming in, it does introduce a lot of risk and a lot of jeopardy to the scheme.
And just on that, we know at present there's currently different plans with a pre and post company plan. Would you know how these schemes would differ in the current proposed changes? Will new entrants be on yet another completely different scheme, or do we know that answer yet?
Well, there are several options that have been put forward. One option is, of course, is no change, but it's extremely unlikely that they're going to pay for an extensive review and then say that no change is an option. We know that there's pressure for the government to save money on this scheme. The sort of ballpark figures that have been muted are around £100 million a year. Now, the options that are on the table now are a care scheme. Care means career average, which will basically mean if you start off as a member of station staff or perhaps a night tube driver and you stay there for some years, then your salary won't be based on your final salary, but will be averaged out over your career. So that will mean that you're potentially losing a lot of money. The other one is career average tiered, where again, it'll be over the average that you earn in your career, not your final salary. And higher earners will pay more. And the other one is keeping a defined benefit scheme, but either making people pay higher contributions or cutting the benefits, which will mean less pension, or a combination of both. Those are the options that are currently on the table. And of course, the government ultimately could reject all those options and do something completely different.
Thanks, Steve. So has the ratio of the company paying, has that changed, or is it due to change? And if so, why?
Well, there are a number of factors. It's not a simple question. There are three factors that would determine that. Firstly, there's the debt the company was paying off. It took a 10 years pension holiday in the past. It was then hit by the stock market crash. That debt has now been paid off. That will save the company £60 million a year. The other thing that would affect that would be what's called the discount rate, which is the rate that we're expected dividends to come back from shares and investments in the future. Now, we've, as a board, we're recommending a very conservative discount rate indeed. Indeed, London Underground may not even agree to it. It's so conservative. But that discount rate would also determine how much the company paid in. And again, the final factor would be the covenant. And the covenant is basically if the pension fund goes bust, who would pick up the bill. Now, the covenant is an extremely strong covenant. But I have to say the fact that the government are insisting on short-term schemes, short-term loans and agreements with TfL means that the covenant will be a bit weaker than before. Now, the current rate of 61, which is £6 for the employer put in per every pound that the pensioner puts in, the member puts in, that could well be affected by the fact that now there's the deficit's been paid off, but no decision has yet been taken on that. And until that decision has been taken, I can't really give you an answer.
Thanks for that, Steve. You say that the company have taken a pension holiday before 10 years. Could you do that again? And if so, how would that affect the pension fund going forward?
Well, they could do that again. I mean, the pension would have to be in a really good state. It would have to have enormous reserves, but it's a possibility. The trustees at the moment, I think I could speak on behalf of all the trustees, we would say that wouldn't be an option just now, because with the changes in the proposed changes in the pension scheme, we certainly wouldn't be recommending that the employer take a holiday. We'd fight tooth and nail against that.
Steve, we've heard about the £100 million in savings being bandied about the place. Would you have any more detail on that? Do you know where that figure came from? And
look, it's come from senior managers, and I can only really say that without divulging names. That's the kind of ballpark figure that we're talking about. I mean, they might go for 120 million, they might go for 80 million. But the reality is they want to save around 100 million every year going forward from the pension scheme.
Thanks, Steve. You may have heard that some driver members are asking why we're striking before the review is published. What would you say to them members?
Well, look, it's a good question, and the answer is this: do you really want to be playing catch up when they've taken a decision, and then trying to force them to change that decision? I think sometimes preemptive action is better. If we put on a significant piece of industrial action and we're united in saying, look, the trustee board don't want any changes to the scheme. There are no necessary changes. The trustee board has done a fantastic job in the investment sphere. We've turned this pension scheme around. We've now got 180 million in the bank. There's absolutely no reason whatsoever for any changes. So I think that everybody has got to get behind that message. And unfortunately, if that means taking strike action, that's what it means, because I think the clearest signal need to be sent to this government that it's hands off our pensions.
Thanks, Steve. Can we have a quick look at the what they're calling the in-scope options there? I'm going to put it on the screen for listeners more than anything, Steve. We've got 4 options, haven't we? I hope you can see that. If you could give us a quick rundown on what these 4 mean. Obviously, no changes is quite an easy one, but if you look at the other 3 for us, please, that'd be great.
So no changes there. Basically, at the insistence of the trade unions and the trustee board, because everybody's saying that pension is in a fantastic place. I've been on the trustee board for 10 years. It's been in the best place. We're actually at £180 million surplus. No change is the option that we prefer. However, it's very unlikely that the government are going to accept that option. I think that they wouldn't have gone to the trouble of having a review and demanding £100 million be saved per year if no change was really an option. So the modified final salary scheme, that could mean a few things. It could mean that you would have to pay more contributions as a member. Management would have to pay less. It could mean that the benefits that you get, the amount of money that you get out at the end, is cut. It's less than you get at the minute. Or it could mean a combination of both. You pay more money in and you get less money out. And I think probably option 3 would be the one they would go for. They would increase contributions, and they would decrease the amount that people get at the end of their pension scheme. A DB care, tiered contributions. That means the final salary pension scheme would remain in force, but it wouldn't be based entirely on your final salary. It would be your career average. So, for example, if you started as a CSA on stations, worked there for 4 or 5 years, then got a job as a driver, the 5 years that you spent on stations with an inferior rate of pay would then go towards your final calculation. You wouldn't be getting the final salary that you're on at the minute. And of course, if you were a night tube driver, that would be the same. You could spend 3 or 4 years on night tube, then move over to a full-time driver. You might then end up as a train manager. Again, it wouldn't be your final salary that things would be based on. It would be the average salary of your entire career. And what tiered means is that those that are earning higher money would be paying higher contributions than those that are paying less money or being on a less salary. And DB care is exactly what I've said for the previous one, but you don't have the tiered contributions.
Thanks, Steve. I just want to concentrate on the DB care plus the tiered contributions because it's a two-tier question. Basically, one, what happens to the money accrued in a driver's pension pot already? And for the career average one, does that take it back to the beginning of a person's career? And so will that affect what's in the pot already?
So the pot up until the changes are made is safe. That's there. But the career average, it will affect what people get out of it. If a driver spent 5 or 6 years on stations, if they've now gone on to be a train operating manager, they won't be getting their entire pension based on what they earn when they leave the job, which is what people get now. They will be getting it based on an average over the years. And of course, the average is, for example, I better explain this part. The average is what today's equivalent would have been. So if you started as a CSA in, I don't know, 1987 on 20 grand a year, that would probably be today's equivalent, maybe 30 grand a year. So it's not exactly, it's not like 2 and 6. It's today's equivalent of what that would be, but it would still mean a big reduction, a big chunk out of people's pensions, what they would expect to get today.
Thanks, Steve.
Okay, that is all of the questions for now, Steve. So thanks very much for taking the time to answer them.
Thank you.
And for all the members that are listening, if you do have more questions, please speak to your branch. Please speak to your reps. We do have experts like Steve, available to answer questions that you have. It's better to have a question and ask it rather than, say nothing. And like as Steve said, we need to build this dispute, and information is key. Go ahead, Steve.
Can I just say one thing? I've been a member of the RMT for over 30 years. I think it's 32, 33 years now. And I think this is probably the most important dispute over pensions that we will ever fight and you will ever fight. This isn't like a pay rise. It's not like you can get a bad pay rise this year and then you can make that up next year or the year after. If this final salary pension scheme is gone, it's gone. There's absolutely no way that it's coming back. They will not even contemplate coming it back. It doesn't matter if London Underground, TfL see passenger numbers in the next few years go through the roof. If they see their profits go through the roof, this pension scheme will not come back. And this will literally affect you as a member until your dying day. And perhaps your wife or your partner or whoever it is that your loved one is that is going to benefit from your pension, that will affect them as well. So I think if you're going to fight about anything, this is the one that where everything has to be thrown. We have to throw the kitchen sink at this to protect this pension.
Thanks, Steve.
Couldn't put it better myself. Right. Okay. Thanks very much, everyone. See you on the next episode, maybe.